Hey guys, Stockaholics, thank you guys for being here today. I am with Calvin Froedge and Nicholas Jacobs, I think two shipping OGs I would consider. Uh, Calvin, you have a shipping service called Marhelm. Actually, maybe you want to introduce yourself first of all, Calvin. Go ahead. Who are you?
Yeah, hey, I'm a investor based in Panama. I have a small real estate business here, and I have been doing kind of commodity energy shipping related investing since 2015. The first time that I got really involved in oil tankers was in 2019. This was in the lead up to IMO 2020. This was like the big change in the fuel regulations. So, that was when they basically put a cap on the sulfur in marine fuel. And that was a really big deal because, the entire refinery economics is built on what you can do with kind of each product that you get out of a barrel of oil. So, a barrel of oil, you get kerosene, diesel, gasoline, jet fuel. The stuff at the bottom of the barrel is fuel oil. Okay, so sometimes they burn that in power plants, sometimes they burn it in ships, sometimes people burn it for heat. Okay, bunker fuel, right, for ships. So they were changing the spec for that in 2019. I was actually in some refineries and oil stocks back then, which was, kind of how it came on my radar. And I said, hey, this is going to be really good for tankers. Turned out it was. Then COVID came along, and things kind of got crazy. First we had a big crash, then we had the super contango, and everything went straight up, and then we had another crash. Things kind of bottomed out, and then have gone up from there. I guess like fall 2020 was kind of the bottom of the tanker trade. Anyway, I started during that summer 2020, while things were crashing after the contango. I started a data analytics site called Tanker Data to track some of that information, look at the rates. I started buying fixtures from the brokers so that I could see the actual deals that were being done by specific companies. And that's just kind of grown over time. I started out with like a promotional offer, $175 a year for people to support that first version. And now, a couple years later, it's grown a lot. We cover every major shipping segment: dry bulk, tankers, LPG, LNG containers. We get fixtures, S&P data, new building, scrapping. We go through all the market developments, do like a weekly roundup. So it's grown a lot. Anyway, that is probably my primary focus, along with investing. And I'm mostly in energy and commodity related stuff right now. Historically, I've kind of always gravitated towards energy, mining, commodities, shipping, because I just, I feel like there's a lot of fake stuff out there. There's a lot of manipulation. I don't like this government money printing. I don't like, the philosophy that you don't have to produce things. You can just, run a money printer and then, buy things super cheap from some poor, stupid guy in the third world that breaks his back with a pickaxe all day. Right. I mean,
cobalt mines.
Right. So I just kind of, I invest in these sectors, just primarily because I feel like, they're kind of real. I feel like we've got kind of long-term, people say, oh, you've got long-term structural deflation. Maybe if the demographics get bad enough, that's true. But I think, if you go back over the last couple hundred years, if you look at, things, if you look at fiat currencies denominated in gold or in any form of energy or in housing, the trend is always in the same direction. Real things get more expensive and fiat currencies buy less, right? So I think, I was also kind of in Bitcoin and gold really early. I think those were two of my first big investment successes. And kind of the same reason. I just kind of like the fundamental nature, something real, something that's actually used. Bitcoin, of course, was a proxy for energy. The proof of work currency, was basically a demonstration that energy had been expended to do this, right? It wasn't just a database change. It wasn't just a money printer. So that was an interesting philosophy. And so I kind of gravitated towards that early. So yeah, I suppose, you asked about philosophy, investment philosophy. Mine is invest in real things, invest in cash flows. I think in shipping and, commodities, you tend to get both of those.
Okay, cool. And we're also with Nick Jacobs. Would you like to introduce yourself too? Welcome.
Yeah, I'm Nick Jacobs. I'm known as Capital Markets on StockTwits or Hobby on Twitter, or even in Marhelm Discord, I'm known as Hobby as well. I can second and vouch for Marhelm. I actually, it's made my tanker analysis a little bit easier for me, because I used to calculate the navs based off of the ships, the age, then have a formula that derives the value based off of inputs of that change. And now Marhelm, I don't think Calvin really dove into it, but that nav calculation is very helpful in Marhelm. So if anyone who's listening that follows you guys, Marhelm is definitely a game changer when it comes to time consuming and reducing some time that you have to waste in Excels. But going based off of me, I started trading when I was like 18 years old. It was like 2007. And I was like just new to the whole thing of trading. I was in and out. In 2010, I was the first time I got exposed to tankers. And I got burned pretty bad on Nordic American tankers from $30 down to, I ended up finally, like, my last purchases were like at $10 to average down. I was buying a lot and I sold it at like 15. So I made some money by 2015. It was the worst trade of my life.
Bad timing. Yeah.
I was very uneducated about tankers. And I feel like that whole period was really 2020 to a lot of retail people. And that's why I really made a voice in StockTwits, because there were so many people that were just saying tankers to the moon. And I was probably one of the few that was like going against the grain, saying this is not going to play out the way people thought. And I probably made more enemies on StockTwits and people blocked me, but I kept saying Nordic American Tankers is not a $750 stock. It's not a $5 stock. It's more like a $3 stock back in May when the stock was like $6 a share. So moral of the story is, though, from 2015, I actually started to dive in to tankers, started to figure out, like, what's really going on and why did I have such a horrible, 5 years experience of trying to make my money back, which I did, but it was a headache. And so, like Calvin said, it wasn't until like 2019 where I really started to see the dots connect. I did own like DHT at like $4 and I just bagged it. It was like 2016. I knew they just finished a lot of restructuring. So I was like, I'm just going to buy this, hold it. I have a theory that it's going to work, but over the time, it panned out. 2019, 20, I sold tankers at the high, and then COVID hit. And then I bought everything into Nordic at like $275 a share. I mean, I had like 80,000 shares in Nordic American tankers during that time period where COVID hit. So all the tankers just dropped out of nowhere. And then Saudi Arabia and Russia had that spew, and it was like a God gift, because then Nordic now shot all the way up to $9. I was out by $765 was the price. I left 40,000 shares on the table and kept 40,000, sold calls, bought puts. And then I went on and I was telling people, this is not going to play out how you think. As soon as Herb hit that CNBC channel, I was like, this is over. It's going to sucker so many people in. I felt bad. So I felt like it was my obligation to go out there and say, look, I've learned from Herb from 2010 to 2015 how Herb plays the game. And it's going to end bad. And what happened? He starts selling shares. He was saying he's buying shares at $5. He would sucker people in, and then shares will continue to drop. He would say, I'm buying shares at $3. He would sucker in more retails. I mean, I was there in 2015. When I sold out, I contemplated about buying back in because I started to learn more about tankers. And lo and behold, like 16, he sold, I think, a huge amount. I want to say it was like 25 million shares, took it from $10 straight to $8. And then he walked out there and had, no offense, but he had the cojones to walk out there and buy 100,000 shares and got suckers to buy it. And then 5 months later, he sold like another 25 million shares and it dropped to $5. And people just kept saying, they're panicking. And he kept doing it all the way down to like $2 a share. So 2020 came and I felt bad because people just kept falling for that trap over and over and over again. And it's common amongst tankers. I've learned that over the years, but I've also learned DHT and Frontline and all these guys are not exactly like Nordic or some of the Greek shippers. So it's made me very interested in tankers, especially starting in 2019. I really dove into it. And just like Calvin mentioned, there's a lot of regulations coming in over the next decade that I was just like, these numbers are, I mean, on paper, it just makes it seem like they can be unreal, the effects that are going to happen versus, buying a rental property. And, you could probably get 10% on that. But if you do the tankers right and everything adds up, you're going to get a far greater return. So I mostly spend my time now on just tankers, some dry bulk. And then I have a few theory plays after this all cycle ends, but we'll get there when we talk about future strategies. But that's pretty much what I'm into right now. And yeah.
Very cool, Nick. By the way, I'll put some links to all these guys' social medias and also to Marhelm if you guys are interested, that somewhere in the comments below. Let's talk a little bit about tankers today. So I guess right now the tanker rates are doing quite well. Is this kind of the same in your guys' mind as it was in kind of like those short 2019, 2020 kind of cycles? Or is this something different this time? Do you think that this market is more sustainable or is it just another short cycle?
So I think most people that got into kind of the retail tanker trade came in at the kind of the height of the contango in 2020, like May, when Saudi and Russia had this price war going on, and they were just kind of pumping everything that they could. Right? They were literally booking any tanker that they could find, and so but at the same time, demand was cratering. Right. And so eventually they decided to stop doing that, and prices tanked. At the time I was, definitely as starstruck as anybody by the rates they were earning. And I mean, in retrospect, holding those shares was the wrong move in the short term. But at the same time, the way that the balance sheets changed and the dividends that those companies paid. So I came out of 2020, I was mostly in tankers, and I came out of 2020 with like a 5% gain, which was, way underperformed. I think the S&P 500 that year, but I didn't lose money on the tanker trade because I was selling calls and collecting the dividends the whole time. And then if you didn't get disgusted and walked away, if you bought in October of 2020, a lot of stocks, Sting hit like $8 a share after the contango bubble burst, and they were more leveraged than most, but today they're trading at $38 a share. I think they went over 40 a few days ago. Teekay tankers, went down to, I think, $7 or $8 a share. They're at 23 today. DHT, I think, got down into maybe even the $3 something a share range at one point, $3-4 a share. Maybe that was before contango, I don't remember, but they're at $7 a share now. They've paid a bunch of dividends. Most of these guys, it's the same story. They've paid off, huge portions of their debt. Their balance sheets are in really good shape now. So asking, is it the same as the contango in 2020? No, it's, completely different dynamics. You don't have a big global demand problem, for one thing. You have an oil market that I wouldn't say is well supplied, but it's adequately supplied. The kind of geopolitical changes out there, I think, are the kind of the main driver for the tanker market. So, basically what happened, and then also the refining capacity issue. So, basically what happened was during COVID, a bunch of refineries shut down. I think the US lost almost at one point 10% of its refining capacity, and a lot of that still hasn't come back. So, what that did is increase refining margins. And that started happening even before the Russia-Ukraine stuff started up. Now, the Russia-Ukraine stuff, that absolutely changed the market a lot in multiple ways. It changed it for clean and it changed it for dirty. It kind of increased the ton miles on the dirty side by quite a bit. Instead of selling so much to Europe, Russia started selling way more to India and China. The US stopped buying as much. So they stopped selling to their traditional trading partners who were close by and started selling primarily to India and China, who were much farther away than Europe was. So that's been kind of, I think, the big thing that has been underneath the tanker market since February, when the invasion happened. But if you think back to last year, things were actually looking pretty good for the dirty market in like August, September of last year. Things started picking up, and then the SPR releases, kind of threw things off track. But at the same time, the clean market was really picking up. Q4 for clean tankers last year was profitable for a lot of refineries. The handy rates in the Mediterranean were crazy last winter. So some things had already started improving materially. We had that big hurricane last year that knocked out a lot of US oil and refining capacity. That kind of knocked things off balance. Every time something like this happens, it just, and things get thrown out of balance, usually shipping companies benefit. Usually if there's chaos, shipping companies benefit. So I would say that, today, look at what you got. You got China that is still not anywhere close to being, kind of at full stride, economically. They're kind of, intermittent lockdowns. They're, way behind their GDP targets. Half the world is in recession already, or at least has really high rates of inflation. They've seen, a drop in real growth or real GDP. So despite all of that, the tanker market has been extremely strong. And, when I say extremely strong, I'm looking, at the rates that, are getting booked today. And this is, without a scrubber, you're talking about, 30, 40,000 a day on a Suezmax, 50, 60,000 on an Aframax. We saw, VLCC fixtures in the last couple of weeks, $50,000, $60,000 a day. We're talking every single fixture that gets done in the LR2 markets, the MR markets, the handy size. We're talking 35, 40,000 plus. We've seen some small ships, some MRs, go for like $100,000 a day. The refining margins have just been off the charts, and people are, kind of freaking out because they've come down a lot. But I last time I looked at the cracks, I think was this morning or yesterday, it was like $38. Crack spread. That's like, more than double the historical record before this year, right? So the incentive as a refinery to import as much crude to run through your refining units and export as much product as humanly possible has never been better, right? Now, as crack spreads come down, I can see that, I can see the tanker market softening some, but, that people are kind of come up with this false equivalence on oil, and, people will sell tankers if the oil price goes down, for example. But again, in a contango, in 2015, for example, was a great year for tankers. And that was a year of contango. It was a great year for dirty tankers and clean tankers. The market was oversupplied. The tankers are all about, and shipping in general is all about ton miles. It's the total distance that a given fleet has to traverse. So if you throw something in there like this Russia disruption, and a lot of the fleet starts going 2 or 3 times as far, then as a whole, the tanker fleet has to put in far more miles to do the same amount of trade. So the shipping rate goes up. If you have a situation like contango where you start getting barrels taken out of of ships getting taken out of the market to store oil or to store oil products, it doesn't increase ton miles, but it does make the effective fleet size smaller. So that's usually why rates go nuts during a contango. Now they might crash afterwards, but that's usually also very positive for tankers. So the environments where tankers don't do well are in a market that is both undersupplied and ton miles are decreasing. So if the distances of trade routes decrease, that's bad for tankers, lower ton miles, right? If the number of cargoes decrease, fewer oil shipments, fewer product shipments, that's bad for tankers. But anything else, more product shipments, more fuel shipments, more oil shipments, good for tankers. Longer sailing distances, good for tankers. Slower ship speed, good for tankers, right? So, lower ship speed, that's another one that's going to come into this play with the new, play this year with the new environmental regulations. That's going to affect all of shipping. So, basically with all these carbon emissions reductions targets, ships are going to have to slow down. There's going to be an even wider premium for modern eco ships versus older ships. Some charters are just going to completely avoid older ships because they don't meet emissions targets, and they, essentially will have to pay a tax on their emissions profile. So, the EEXI and CII regulations coming into play, that's also going to be a big difference. So I would say, to sum up, is it different than 2020? I would say absolutely. It is absolutely nothing like 2020. We've never seen a market like this. Most shipping bull markets are a little bit different than the shipping bull markets that preceded them.
I would agree with Calvin on that. I mean, I look at it like how I look at it like miles per hour for like a lot of those old ships, because it's hard to explain it in the shipping world to individual people. So like if you look at miles per hour each year, so say 2023 will be like 18 miles per hour. So you have to slow steam at 18 or less when normally you're going 20. So then next year, the following year, 2024, the mile per hour is going to be like 14. So it's going to be a huge, not 14, but like maybe 16. So those ships that are going 18 or less now have to even go slower, that are not eco or scrubber. That's the way I look at it going forward from 2023 to 2030. Eventually, those ships that are not eco or scrubber, they're going to have to go like 8 miles per hour just to barely get over the certifications, in my opinion. And that might not even be enough at that point. So, I look at it as like miles per hour. They're going to have to slow down. If they're not going to invest in their ships, what's the point of putting on new scrubbers on a 17-and-a-half-year-old ship? That's almost ridiculous, in my opinion, because you're going to make, look at TNK. They got ships that are not scrubber. They're making good money, but I don't see why would any ship owner want to put on scrubbers on like any ship that's over 15 years old right now. That doesn't make any sense to me. That's a sunk cost that's just going out the door. And just for what, a few more years of trading, and just so you can get it to be meeting requirements? That doesn't make sense to me. So in my opinion, I see that the market is kind of like starting to, for dirty tankers, I see it as like a warm-up phase in a 9-inning ball game. I see the clean market as like we're in the bottom of the first, maybe top of the second, and starting to really get the ball game starting to roll. But I think, like how Calvin said, those regulations are really, I don't think people understand how that's going to play, especially when you have shipyards like full all the way out to 2026 almost. I mean, if you were on the Euronav call today, Hugo was talking about how you can't get you can barely get any berths for 2025 for a VLCC. He said you can maybe squeeze in 1, 2 for Suez in 2024, maybe a few more in 2025, but nothing's there. And 2026 is already starting to be filled up by LNG. So where's this time frame going to look like? I mean, if you're gonna by 2027, my numbers show we could be right around almost 30% of the fleet is going to be 20 years or older. I mean, without scrapping and without new fleet, what do you think is going to happen? I mean, I personally believe the prices of assets for scrubber and premium for eco are going to go higher. And I think the rates are also going to take off. I mean, the math just doesn't add up if the oil projections are 104, even on the low end for 2026 million barrels of demand. I mean, that's like another, 104, that's 4 million more barrels. That's 2 million for VLCC. That's round trip 45. So you need at least almost 90 more ships from 2020 to 2023. VLCCs put in 100 new ships are going to hit the water from 2020 to 2023. I mean, right there, that just absorbs all of it. Now that's not even factoring what Calvin was talking about, where ton mile is also increasing, and you also have aging fleet. So it's like, I think it's a market that tankers have never really fully experienced. And I think this is just the beginning. Yes, we might get softening in rates. I think they could probably come down like Calvin was saying, but I think this is the beginning, and it could last, in my opinion, all the way to 2030. I mean, there's just no way. If you look at,
if you don't care, if I can jump in for a minute, like 9 months ago, end of 2021, I think you were actually on that call, Nick, where we were talking about how after the SPR releases, there's been a big drop off in some of the tanker shipments. Because a lot more was getting consumed kind of locally by the refineries, less was getting shipped.
Yes.
And so, everybody was kind of freaking out about how, 2022, we're going to have all these deliveries. The order book after this year looks a lot better. It's actually the lowest it's been in decades, really, as an aggregate. But people were saying, but the fleet's still too big, right? I mean, we've had, how many conversations do we have about this subject, right?
Yeah.
So, we kept saying, but the fleet's still too big. We have to see some of these 2001, 2003, 2002, 4 or 5 ships. We have to see some of those get scrapped first. Rates can't be good until then. So it's more of like a 2023 to 2029 story or whatever, right? And
Yes.
And then this Russia-Ukraine thing happened. Ton miles changed.
Yep.
And we've still had all these deliveries, and look at rates, right?
Exactly.
So there hasn't been much scrapping. Look at rates, right? So, so it's not just ship supply. Ton miles is the big one.
Yeah, the ton mile has really actually changed the landscape for 2022 to where, like, if you go back to 2020 or 2021, this wasn't there. I mean, if we were seeing rates like this in 2021, but the ton mile never happened, I would definitely probably walk out and short Frontline right now. I would be like, this is not sustainable. But now, as everything is developed in 2022, it's changed the landscape. And I know I get conversations with people who say, well, they're not going to scrap and they're just going to move over to illicit. Well, look at it this way, though. If they're moving to illicit, what's the illicit market going to do? The sanctioned market's going to sit there and say, I need to make $45, $50, maybe $60,000 a day regardless on a ship. They're not going to bring in 100 more VLCCs to flood their market and make it so that they're now losing money. That's not how the game works. And there's only so much oil in the illicit market that can move. So those ships are going to scrap. It may not be right away. You're not going to see it like tomorrow, if Iran stays in the sanctions, Venezuela stays in the sanctions, and Russia gets full blown sanctioned, those ships that are in the legal market will move over. They're going to meet a demand over there. They're going to sell the 17.5-year-old vessels, and they're going to last until 24 years old, maybe 25. I would say the illicit market usually scraps probably anywhere between 22 and 25 years old. The actual legal market, like the Western countries, we usually you just saw Nordic. Nordic sold ships that were 2001 to 2003 years old. And what year are we? 2022? So they're like 20 years old ships. They've been selling off their 20-year-old ships now. I mean, that's how Western world countries think. So they're selling them most likely. I think they went to illicit markets. They didn't go to the scrap yards. That's how the cycle moves. So now there's less ships that are legal in the market. You already know the count that's coming in. So you're really depleting the legal market, and they're moving to the illicit. Now the illicit will then start to scrap their ships because they don't want to take away their $50,000 a day spot rates or $100,000. Because I heard back in 2020, I heard some of those illicit ships are making $85,000 a day, and while spot rates for a VLCC was like almost zero. So it's like they're not going to want to flood their market. That's just stupid. That's going to destroy the illicit market. So they're going to suck up all of those 17.5-year-old vessels. As we get older, they're going to be eating those, and they're going to start to then scrap their 20, 22, 23, 24s. And then when you get to 2027, when there's like, maybe we have actually maybe 10% of the VLCC fleet actually coming on board again, but you've already depleted probably 30% of them, you're going to actually start to see those illicit market look at the 17.5-year-old VLCC that is actually eco, because you're probably going to start seeing those 2008 to 2015 miles that some are eco, some have scrubbers. I don't think a lot of them have scrubbers, but you're going to start to see those fleets be cherry picked by illicit market. And then they're going to get rid of all of their gas guzzling vehicles, their gas guzzling tankers as well. So I think it's just like a revolving door where eventually they will trickle out of the market, and then they're just going to keep absorbing the legal market. So the legal market's going to be constrained, and it's going to get tighter and tighter, almost like a boa constrictor, where they're just squeezing the neck until eventually I think everything just explodes to the upside. And I think we're probably maybe a year, 2 years out until things start to really get in a panic mode where it's like, wow, a VLCC could be hitting $85,000 a day and possibly even higher, because there's no supply coming on for tankers.
Yeah. And
it could get out of control. And I think the tanker market is starting to realize that. And I think owners are starting to think, this situation's coming. I have a vessel that's 17.5 years. I have constraints. If I keep it in the legal market, I can sell it. I can scrap it for, I think usually the Western countries scrap it at, Turkey, I think, for like 300 a pound, or not a pound, a ton, or deadweight,
yeah,
I mean,
a ton.
Versus sending it to the illicit market, where then they'll eventually realize it and put it in the 600. So, I mean, they're at the point where they see I think they see what's coming. They also are constrained. They're handcuffed by prices of assets. I think they're handcuffed by supply. I think the secondhand market's the only way to get access to ships within the next 4 years. So I think asset values are going to really rip to the upside in the next 3-4 years.
I agree. And I mean, on the ship age profile, so let's go back to, shipping for the last few decades has been all about environmental regulations. Okay.
Yep.
Let's go back, environmental regulations in China. Okay. Those have been two of the biggest factors. But on ship supply in the early 2000s, you had this set of regulations called double hull. Okay, so the way they used to build tankers is they would have just a single hull, kind of a single layer of steel on the tanker. And then after some big high profile oil spills, they started saying, hey, look, we can't have these oil spills. They're expensive to clean up. They're terrible for the habitat. They kill a lot of wildlife. They ruin beaches. They, are destroying parts of the ocean where they happen. So we need to do better. So, they said every tanker that is on the water needs to have 2 hulls. So they had to, at least the big ships, they either had to retrofit to add a second hull, or they had to scrap and deliver new ships. So a lot of that boom in the early 2000s in tankers was about the supply constraints created by those double hull regulations. Anyway, the net is the majority of Panamax tankers on the water today were built between 2002 and 2007. Okay, or it's even 2004 and 2007. Okay, there was a huge spike in VLCC and Suezmax orders in the early 2000s, an even bigger spike, at the end of the cycle, and 2009, 11, 12. But that 2000 to 2005 period, as far as tankers go, lots of LR1s, lots of Panamaxes, lots of handy-sized tankers, lots of MR tankers, lots of Aframax tankers, and those ships are all turning 20 or already have been. The Panamax fleet is basically going to disappear over like the next 5 years. Okay, so it's going to get a lot tighter just because the fleet is so freaking old. Okay, like people don't understand this is like an inevitability, right? That the fleet is going to get much smaller in the next 5 years, much smaller. And if things stay tight like they are now, if the dynamics that are at play, right now, I personally think unless we have some crazy event like, nuclear war, mass famine, some kind of mass die-off that, literally kills 1 billion people, okay, hundreds of millions of people. That kind of scale, apocalyptic, okay? Unless that happens, I just don't see how tankers can be a loser over the next 5 years or so. The supply dynamics are just so freaking favorable. I don't think that the order book is as tight as some people do as far as being able to get new ships in, because I'm looking at the data every week. I see orders come in. I see 2024, 2025 delivery dates. Ship ordering can always kill a cycle. But we're starting at such absolute low levels, where we're looking at like, depending on the sector, let's say 3 to 7, 8% on the order book for tankers. It's just, it's impossible that the fleet can grow in the next 2 years. Okay, like it's just not going to happen. You go out 3, 4, 5 years, it starts getting a little bit more iffy, but there would have to be this big ordering spree within the next year or two for this cycle to kind of get cut off soon. So I would say that I think that the biggest problem that people have with trading these shipping stocks is they tend to get sucked in the volatility on the way up, and then they get washed out on the way down, right?
Yes.
And so at Marhelm, what we try to tell people is, look, you need to take a longer term view of the cycle. You're playing like this entire cycle. When things are cheap, that's a good time. And even in a good market, there's going to be volatility. We've seen, just a sell off, just recently, right? Frontline went from in June, it was trading at $11.43, and in July it traded down to $8, right? That's pretty big volatility. And then a few weeks later it's back up above $10, right? That's pretty big volatility. So they say investors tend to buy high and sell low. I have have absolutely observed that to be true and the kind of general population. I mean, even in Marhelm, I mean, it's almost like we joke sometimes that it's like, it's like group therapy for commodity and shipping investors, because, we have to be like, like, just be patient, man.
Yeah.
Yep.
Don't get over your skis. Don't put on too much leverage. When there's a sell-off, it's an opportunity to add. If there's a big short-term volatility, you should probably take some chips off the table instead of double down. If there's going to be dividends, big dividends, then maybe sell some calls to offset the ex-div drop, right? If your shares get called away, well, you did a pretty good job on catching that run up anyway. So
Exactly.
yeah,
that method was great for dry bulk all of last year, even this year. Some of these guys are playing really well. So, I mean, like I did it with Eagle Bulk constantly for the past, 3 dividends, where I would just walk out there and sell the covered calls, and I would make $1.50 on the covered call and the $2 dividend. So I'm just like, I already gained like $15, $20 just in stock appreciation. And now you add in $1.50, $2 premium on the call I just sold. And actually, people haven't been calling it away. So
right, you're like, who the hell is writing these calls?
Exactly, but they're taking them like it's candy. And then
who the hell is buying these calls, right?
Exactly.
Yeah.
But I mean, it doesn't hurt to take some money off. I mean, just recently, I trimmed a little bit of my Frontline and DHT only for the sake of I saw Euronav's earnings. I know exactly what they got on their not their scrubbers, but their total fleet spots. And I just feel like, we've ran quite hot the past 2 weeks in tankers, to where I'm just like, I can take some off and just see how the earnings play out. And then I can always add back when it comes. I mean, I trade based off of ranges and where I think the stocks should be. And if they go above that, I usually play with possibly selling some covered calls, or I just let it run and I don't touch it. Or if it trades within the range, then I start to actually look at, okay, I'm going to buy some. So like right now I'm looking at Frontline, and I'm looking to possibly start adding again at the 960 level. I'll start to add back those shares I just sold. And next year I have a range of like $15 to $10 is where I think the stock should trade next year. So anything in that area, I'll be buying next year. But I mean, that's the way I just see tankers in general and the stock prices and how it correlates to like the macro of tanker land and in the fact of selling covered calls to collect extra premiums on these things. Because I mean, you can get some of these suckers to give you 5 cents, 10 cents that are like literally 30% out of the money. I mean, that stock will have to move 30% in order for you to lose your shares. But if you're going to make 30% on a stock, that's astronomical in a 2-month window. I mean, you can't beat it, in my opinion.
Yeah, it kind of gives you some discipline, to be like, okay, the stock went up a bunch. My shares are getting called away. I should have taken profit anyway, right? I mean,
exactly.
To me, call writing is a super, super important strategy to add, especially if you're in these, kind of volatile commodity markets. Now, I mean, I don't think there's this ape mentality of buy calls out there is ever going to be defeated. I mean, even in Marhelm, we see people like it seems like everybody always prefers buying calls. I mean, the majority of activity has to be call buying, right? I very, very rarely buy calls, but the thing is, when you're a big call buyer, if you have, it's like leverage on top of leverage. I mean, if you're buying calls and you're buying calls on margin, a 10% move in the underlying is huge volatility for you, and so I think that's another reason why people tend to, kind of buy high, sell low is they, it's just kind of hard to handle that volatility. Anytime we ever have, guys that are, I see they're, really, kind of struggling, talking about, like just kind of really hard, bitching about the market action. I'm like, dude, it sounds like you're using way too much leverage, but
Yes.
owning the underlying, collecting a dividend, getting paid premium, no matter what, even in the most pessimistic scenarios, even if it went to zero, right? If you're buying stuff that's paying 20, 30% dividends, and then you're getting another 20%, 30% premium a year, writing calls, dude, it's impossible to lose everything. It is freaking impossible to lose everything, right? And in almost every case, you're at least, I mean, if you want to, the best investors in the year, the best investors in the world, like the people that, others point to as like, these are the greats, your Warren Buffetts and, your Ray Dalios, et cetera, your, Carl Icahn, George Soros, whatever. Okay. Over long time periods, if these guys do 20% a year, that's like world class. That's like the top few percent of fund managers, right? And everybody, it seems like, wants to get, they want to double their portfolio every couple of months, right? And in order to do that, you're taking these risks that expose you to downside that you're probably not emotionally equipped to handle. Now, some people are. I mean, we've seen people in Marhelm, increase their portfolio values thousands of percent in, short amounts of time. But those are the same guys who get killed in the drawdowns a lot of times, right? If you can make, 20, 30% a year consistently because of dividends and selling premium, you're going to be rich as shit when you're old. Okay. Like, I mean,
yeah.
Right. So you just got to ask, do you want to play the long game or do you want to be rich next month?
Well, for me, I try to focus more on just holding because I want to play a bigger term move. So like I want to hold companies that I can trust, kind of hold those and try and hold them through the whole cycle. Because I kind of just see a bigger long-term picture out there. And like if I start messing around with all these options and start getting tricky, I know I'm probably just going to lose money for me personally.
Which is for Mark, I think, trading around your position. So for me, like there's times when I leverage up. So like Calvin and I, you go back to DHT's last earnings, Calvin and I were slamming the table for DHT at 5. I don't even know how it got to 5 in the first place, but it traded at 5. And Calvin and I were like on multiple platforms just saying, buy right now. Yeah. You're going to be thankful. And lo and behold, a big whale actually read our messages and bought. And we were buying. I mean, everybody that was following us was buying at $5. And what happened to DHT when they announced? They opened up at like 540 or something like that, 545. It was a huge move on the earnings. And it was like, that was like a no-brainer almost. Like, how do people not understand? I mean, I guess if you don't understand tankers, then you would not.
But then like DHT, it's, $7 and something over the last few days. I mean, I unloaded some calls that I had on DHT. The reason I bought those calls on DHT was because, the option pricing was crazy and there was no premium on them. So I could own, I knew there wasn't going to be a dividend and I could own, way more shares, for a much lower price without paying any premium essentially. So, that's kind of why I did that, with options this time around. But, I know that DHT is not going to report, crazy earnings. I know that they're not going to pay a big dividend. So, I'll buy back in on the next dip. So, I am totally agree with like, investing over the longer term and, like playing the whole cycle, but also like, being able to trade around your position, a little bit and, entering by selling puts, by writing puts, exiting by writing calls, that 20, 30% extra premium that you can get per year by doing that option writing. I mean, you can still get, sometimes you get a position gets away from you, but I mean, I don't know how many positions you guys have, but, I've got 20, 30 positions pretty much at all times in my portfolio. Some of them I get fucked on, some of them I don't, right? On the average, I tend to make money on most positions.
Yeah, exactly. And I mean, even if I don't think you're going to miss the boat on tankers moving, but my thought process is, if you feel like you're missing it, FOMO, don't walk out there and buy the stock right now. I would actually say walk out there and look at premiums on puts that are in the money and that are out on the curve a little bit, and literally just sell those and put the stock. I mean, why would I buy DHT at 7 when I could possibly maybe get like 30-cent premium on a probably like a couple months out, if I sold like an $8 put, I mean, that why would I walk out there and buy it? So I usually I don't always straight buy. Sometimes I do the puts that are in the money, puts out of the money, because I know that price just doesn't belong there, or at least I feel like it doesn't belong there. But sometimes I do get wrong. I mean, I've been wrong so many times on Frontline on the bottom calling that I get killed. But I end up just swallowing it and just taking the shares and calling it a day because I want the shares anyways. But yes, I would say shipping is not a get rich quick game. It is, you have to have like the longevity viewpoint. You may become rich at the end of it if you look longevity. But if you look short term with the idea of getting rich and like just shipping in general, you're going to be one of the guys that's actually poor.
You could do really well, but you know, the volatility can go both directions. I mean, shipping is just prone to kind of things that you didn't see coming, you know, like big changes, right?
Exactly.
So, Atco up 20% on that buyout offer.
Wow.
Crazy. So I was just curious to just bring up the option chain on DHT, for example, and, you know, kind of look at the January 23 option. Okay, so January 2023, it, you know, you might think of it as being, you know, like a long way from now, but it's really just a few months, right?
Yes.
It's a few months. Okay, you think of all of these studies that they've done where they look at people, you know, they look at their habits and they give somebody the option. Okay, look, I can give you $50 today, or, you know, if you wait 30 days, I'll give you $100. And, you know, in all these studies, people would almost always choose the fast money, right?
Yep.
But like, you know, looking at the DHT option chain, now the things might absolutely be crazy Q4 this year because of heating oil demand, you know, for power plants, et cetera. You know, it might be a terrible idea to not have some exposure to DHT right now. Okay, and, you know, like Nick said, if you go out a few months and you you know, sell, for example, the stock is at $7 today. You sell the $7 put on DHT that's at the money, or, you know, even the $8 put that's at, you know, and then the IV is not even very high on DHT right now. It's like 42. Okay, but any which is a pretty low IV. But
yes,
you know, you sell that $7 put, you're getting more than 10% to wait 4 months. Okay. You're getting more than 10% to wait 4 months. You're getting in at the price today, but you're getting 10% in income. Okay. Now you look at, you know, even like the $5 strike, you're getting, you know, 15 cents for that. You know, would I be terrified if I got assigned a bunch of DHT at $5? Heck no. You know, I'd love to have a bunch of DHT assigned at $5. So, you know, having some short put positions, having some common positions, selling calls against that, you know, like kind of like diversifying your strategy about how you're going to get paid from these equities, right? Like, think about these as income streams, right? I mean, like people try to think of just like, okay, I want to buy something and then I want to wait for it to go up. And then when it's up a bunch, I'm going to sell it. Right. But in practice, you know, I mean, take Vertex, for example, VTNR. Okay.
Yep.
I was begging people to sell at $18. Okay. And it's just, you know, like nobody ever, you know, or at least sell calls, right? It's so hard when things are going up to sell then. It's so hard for a lot of people if things are going down and they're losing money to not cut their losses and sell when they shouldn't. By diversifying, like when you're selling options at different time frames, at different strikes, okay, you're basically diversifying your return profile. Okay. Some of it, you know, with dividends, you know, I'm about to get this hopefully huge dividend payout from Petrobras. Okay, I've got tens of thousands of shares in Petrobras. The dividend is $2.61 a share, right? I sold calls against that, but hopefully I'm going to get you know, that paid out. You know, that should come in the next couple of weeks. But then I'm also short some Petrobras puts. I'm short some Petrobras calls. I got paid for those up front. You can sell like the front month stuff that expires quickly. If you sell anything with high volatility, that 30, 60 days theta decline. I mean, man, that is a moneymaker. Like in 2021, one of the things that I made the most money doing was selling Zoom calls. All the big kind of tech high flyers, selling at ridiculous strikes 30, 60, 90 days out, making sure, and I mean, I was selling naked, which is, riskier, but the point is that 30, 60, 90 days theta decay, if you're selling options in that time period, the value of those options declines really quickly. So you're getting paid really quickly, right? I mean, if you sell options, you don't have to think about when to sell your position. And honestly, if you're always selling options, you really don't need to think about selling your stock, because when you sell your stock, you've lost your income stream, right? Like when you have a stock, if you can sell options against that stock, you've got an income stream. I mean, some of these, stocks that we've traded in, maybe they're around $5 a share. And like Nick said, you can sell, a couple strikes out, those like 2-month options for, 5-10%. You're talking about like for 5 or 10 cents, you're talking about like a 1 or 2% income, every month or two. I mean, dude, annualize that, you're talking 15, 20% just selling options a few strikes out, right? And people say vol, vol sellers all blow up eventually, right? That's what they say. But the risk on being short puts, if you have the cash to cover that put, you're not taking much of a risk. Okay, you're taking like exactly the same risk that you might have liquidity issues in getting rid of the position, but you've got like the same risk profile that you have being long the stock at whatever price that you bought it at, considering margin requirements, etc. By the way, guys, don't use margin, and it will make your life a lot easier. You won't need to do stupid things at the wrong time. If you sell the covered calls, you've got the collateral for selling the calls, right? You don't even need to sell naked. I mean, the only reason I ever sold naked calls on something like Zoom is because there's no way I would ever own Zoom stock at that level. There's some price I think I would be long just about any stock, but at the prices that all the tech stuff was at last year, I mean, how could you possibly want to be long that, right? But yeah, just owning the underlying and selling calls. If it's short, you're going to get that rapid theta decay. You get paid quickly. The longer term stuff, you might not. You're not going to see the value of that option decline very quickly. It's going to be something that sits in your portfolio. And if you sold a covered call and your stock is going up, then you're not seeing green numbers on your screen, because the short call is offsetting the value of your increasing common position. And that's frustrating, but I have done that so many times and then got the dividends. And then there's a big sell-off ex dividend. And then the stock goes back down below where I sold the call, and months have passed and I buy the call back for nothing. And I still got the dividend, and the decline in the value of the call offset all of the decline in the underlying security, right?
Oh, yeah.
It's being opportunistic.
Exactly. I mean, it's all about trading with your risk tolerance, really, and knowing when to leverage up and when to leverage down, and just understand your own risk. And I feel like I see people that just don't understand their risk, and it makes it hard, because then I try to explain to them, hey, shipping, there's flash crashes, and we could literally watch tomorrow a flash crash and all the tankers could be down 10% and people will panic. And
a lot of people puke their positions, and right. I mean, the reason they're down is because a bunch of people are selling, right?
It's either they're over leveraged down days, or they think that the thing just fell apart on them. So it's either over leveraged, or they don't understand their risk and the market's turning, and they're afraid that they're going to be the last one out. So then they sell. And then in reality, if you actually position your positions correctly, you could actually be the one that's actually walking in and buying on the bloody days. That's like the old Warren Buffett saying, where when there's blood in the streets, that's when you should be looking to see A, who's naked, and B, who's actually the ones that you want to pick up.
Yeah.
Yeah.
Yeah. So very frequently I go through, kind of everything in shipping because, I know these companies, right? And everything in kind of the oil names, and I'll just look and see what has the highest IV. I'll look at the underlying, kind of the fundamental value, and I'll just say, what price would I be comfortable owning this at? And then 3 months, 6 months, 9 months, a year out, I'll sell puts. And if I get assigned it, well, then, I'm happy to own it at that price, right? Exactly. But I don't sell puts unless I want to own that stock, and I'm confident in that company's future and in its potential dividend stream.
Maybe you could talk a little bit on how you pick a shipping company, because every time I make a video on that, somewhere in the comments, somebody's always like, what do you think about this company, this company, this company, this company? So maybe you can touch maybe the last, because we've been going on an hour, maybe the last last thing. Maybe how do you guys see, is it all valuations? How do you pick?
Okay, so every week in the weekly roundup that I do, I go through, I think we're up to looking at 50 stocks now that's in the slides every week. Yep. So we put 50 slides or 50 stocks in the slides, and we show, kind of the weekly price change. We follow the earnings for all of these companies, right? We do a slide on, earnings highlights, what they made, anything, kind of big that happened. So I would say that we follow the prices and we follow the companies. And by just having an awareness of the space and, following the companies, we know when the opportunities present themselves. We know that if TORM is down, TORM went down to $10. Okay. I don't know if Nick bought any, but I bought a shitload of TORM at $10. I sold $15 calls, the things at $16, $17 now. It went up 60-70% a couple of weeks.
Yeah,
right?
you killed.
But but yeah, I mean, we just pay attention. We look at the price changes every week to see how the conditions are changing. If there's a good opportunity, we jump in. Now, some of us have been burned before, including me, on some of the Greek shipping companies. I lost, I think 70% on Performance Shipping Group. Okay. I really rarely lose money on shipping companies now, but those Greeks nailed my ass on that one. Okay. So, basically the lesson there is kind of just know what you own and know what you're trading. There are certain companies that, they don't view their common stock as something that they should take care of, and they don't care about their shareholders. Right. They really maybe even aren't shareholders in their common stock.
That's what I think a lot of people miss, and they get burned, and then they just stay away from shipping altogether after that.
It puts a bad stigma on shipping, and that's also the side effect of why Frontline's not actually a $20 stock, or why any of our tankers are not a $20 stock. It's because of the bad stigma that kind of just lingers in the market about tankers and shipping in general.
But yeah, there's certain management teams though where they're super solid, and you're whatever those guys do, I'm 100% sure that it's in my best interest, right? They're experts. They own it themselves. I mean, anything that John Fredrickson owns,
yep.
Anything that he's involved in, he's doing that to make money, and he has become a billionaire from his own dividends in his own companies. Yeah. Okay. He is a common shareholder alongside you. Now, there might be, short-term dilution at times. I mean, selling equity, it's a form of capital raise. And sometimes there is a good time to sell equity. Dilution is not always bad. If your stock is trading at a huge premium and you do an equity raise, your cost of capital might be a lot lower than if you were to do a debt offering. And over the long term, I think that's good for shareholders. Okay. Yeah,
there's two examples of that. And they're actually both John Fredrickson's companies. Golden Ocean last year, they did the debt dilution for was it Panamaxes or was it Cams? Not sure which one, but they did debt off or not a equity.
So they shipped for shares. It was ships for shares.
Yes, and it actually benefited them tremendously. And then the most recent one was Frontline, where when they're at like $12 a share, I even made a post on Twitter. I said it would be wise for Frontline to sell shares to either like to look for other assets if it's not including the Euronav. And over the weekend, what they do, they bought shares of Euronav at a ratio that I think that was like 1.37 or 1.38, which would be like the equivalent when the deal is actually going out at 1.45. That was like a no-brainer for Frontline. I mean, that right there is accretive to Frontline shareholders. That's less shares being diluted at the end. So it makes sense for the smart guys that actually issue shares at the right time when they have such a premium over their NAV that it's like, those are the type of shipping companies that you want to be focused on when you are looking for, an investment in any type of shipping company, in my opinion. Besides the management, I mean, if for me, DHT I consider as like the best of breed when it comes to management. Ever since the restructure and how they actually like kicked out the old CEO and like everything just played out so much better under this new management, that they've literally have changed that company around tremendously from the old company a decade ago. And that's the type of companies you want to look for going forward. I mean, like International Seaways, when they took the poison pill on John Fredrickson, I thought that was just not the right move. I mean, at least open the dialogue with John to see why he's there, first of all. So that's why I've stayed away from International Seaways.
You're still in a different tier though, right? So, I mean, if you're talking about which stocks do you not want to own, do you not want to trade, no matter how cheap it looks, no matter how much they've underperformed or outperformed, okay, if the last name of the person running that company is Greek, just do not touch it, okay? Like, I mean, seriously, just if it's Greek, just don't, oh, wait, okay. Okeanis is like one exception to that, okay? OET. And the tankers, okay? But as a general rule, if they're Greek, extreme caution, because they've got this long history of just treating their shareholders like an ATM, where they will literally, like, the stock will be at like a market cap of a few $1 million. The net asset value could be way higher, but they will, like, I got sucked into this performance shipping thing where, I mean, good for them for being smart enough to structure it this way and think it this way. So I just want to walk through what they did real quick, just as an example, so that people understand that, A, this stuff is too complicated for you to see coming most of the time. Okay. And, B, that this is like par for the course. Like, this is like what their CFOs sit around thinking about. Okay. This is what they talk about, at cocktail parties. Okay. This is literally what they do. Okay.
How can I spook Calvin? That's what they said.
So basically they put out, all of this, all these presentations on, how much higher their NAV was than their share price. And they put out all these things about how, in the future, they're going to prioritize dividends, et cetera. And at the same time that they're putting out these, press releases and these presentations, in the background, there's these SEC filings where they're changing their capital structure, okay? And the capital structure changes were essentially where, as a common shareholder, you had an opportunity to tender your shares, meaning, basically offer your shares in exchange for another type of shares, okay? So you could get rid of your common shares and become a preferred shareholder in this new preferred class of stock. Well, most of the majority of this company, at the time, the biggest shareholder was one of the founders. Okay. And the founder and, the other insiders, they all tendered their shares, and anybody could have had the opportunity to have tendered their shares. Okay. Like any common shareholder could have done it, but you would have had to have, read those very long, dozens or hundreds of pages SEC filings, right? You would have to actually go through that. And a lot of people, they just, they don't do that kind of deep research on a stock. They're not going to read every 6K that the company ever issues, right? If you didn't tender your shares, then this is what happened. By tendering their shares, they basically moved all of if you moved the preferred shareholder to being a preferred shareholder, you would receive a small dividend, but most importantly, you would be entitled to a dividend in common shares. And then later you would be able to convert back into the common share structure without any dilution in your underlying position. Okay. So you could sell all of your common shares. Let's say that the market cap's $10 million and your shares are worth 2 million. Okay. So you got your $2 million up front, in preferred shares for tendering. Okay. So after that, you're out of the common part of the capital structure. You're now preferred equity. You got $2 million of preferred equity. You're getting your 3 or 5% dividend on that preferred equity. That can be paid in either cash or common shares, but you've got your money out of the common part of the capital structure. So then they come through and they do offering after offering after offering, just slamming the market with new common shares, selling them at whatever they can market at. They get these shady investment banks and shady group. Like sometimes there's even a company called Kalani that did private share offerings where they didn't even have to register the filings. The company this was dry ships, and they were literally just selling the shares to this private company, which was then dumping them on the open market. They would manipulate it beforehand to get people interested and then just keep dumping it. So the market cap's only, a few $1 million on the stock, but they're making millions per day just on the volume in the dilution. Okay. Just, hammering with whatever bid they can find. They don't care if the stock price is a penny. Okay. They don't care. If there's a bid, they're going to keep hitting it until that money faucet dries up. Right. So and then later, okay, so now the capital structure has been diluted to the point where, the market capitalization of the company is nothing, but the preferred part of the capital structure, its equity value was, it was preserved at the original $2 million or whatever. So then these guys convert back to common shares. And now they own, whereas before they owned, a big position, but, they didn't own all of the company. Let's just say without using specifics, they owned 30% before. And then when they do this conversion 2 years down the road, they come back in, there's way more shares, but they own 100% of them. Okay. Or 99.9% of them because they preserved their equity value in the preferred part of the capital structure. So these are the kind of schemes that, again, if you were a common shareholder reading all of the filings and, digging into these details and, all the gotchas, because even among the preferred shareholders, there are gotchas and there are capital calls, like, for example, so you have to go from point A to point B to point C. And you might need to put in a capital call. So, and if you don't, maybe lose some of your equity interest. So it's like, it's so that they can, get other people out there who might have also read the filings, but maybe aren't as well capitalized, don't have as much liquidity as they do, right? It's a game. So, the point is, unless you are somebody who gets off on this kind of stuff, okay, just stay away from the Greek shipping companies. BW Group, which owns DHT and Hafnia and BW LPG and BW Energy, they're not going to do this kind of thing. They're going to, they might dilute at some point. They have in the past, okay? But it's going to be good dilution. It's going to be for something that they actually believe is going to make more money than they're putting into it, okay? Your Fredricksons, absolutely solid. I mean, even like Scorpio, people give, have given them in the past a lot of crap for some of the things they've done, but they have never, ever done anything like some of these Greek groups have done. I mean, who cares if the commission on fixing or selling a ship was, higher at one point to their private management company. When Scorpio shares were trading at $8-10 a share, their management team actually had the balls to step into the market and, and buy the fuck out of that dip, right? I mean,
Yeah.
They actually have, they actually take an active role in the business. They care about the value of their shares. They're heavily invested in it. So invest in those companies, your BW groups, your Fredericksons, be careful with Scorpio, but they've also, I think, definitely done shareholders a real solid in the last couple of years. Okay. Robert Bugbee has an outstanding track record selling OMI at the top of the market back to Teekay. Okay. Teekay is still holding that bag. Like, what is it? 15 years
12 years
later?
Yeah.
Yeah.
They're still holding that bag, man. Right. So there's some really good shipping companies out there that are going to pay you great dividends. I've got 2020 bulkers, BW, anything BW owns. The Greek guys just, like with a few exceptions, just stay away from them.
Yep. I agree.
All right,
I agree with
guys.
that.
Sorry. Go ahead.
No, I just was saying,
Yeah.
I mean, definitely do your research. I mean, if you guys follow me on any platform, I'm usually mostly DHT, Frontline, Ardmore. I even still support Ardmore, even though with the recent news, but I have scaled dramatically lower out of my position than what I was. But I still believe in their target, and it makes sense, in my opinion, what they might do. It just all depends on how they execute this fleet renewal. That is key to me. But if they take it all the way to 2027, it's going to be a garbage stock. I'll straight up say it. But it all comes down to who you're picking, how you're picking them. I mean, I've been burned. I got burned on ship. Seanergy, I thought they were actually going to do better. Their stock just got hammered, so I kind of just left it. But yeah, I mean, I think to sum up really quick, I'll just say, the future in tankers is there. I think it's moving in the right direction. I don't think you've missed it. I don't think you missed it in 2023 either. If you come in late and you want to see the market kind of get its foot, especially in the crude side, I think the product side is starting to gain its footing in the market to where it can now actually start to use as a springboard to buy back shares, start to restructure their debts, pay down things, get themselves in a better position, because 2 years of loss making can also cause some damage to your balance sheet. I mean, Scorpio struggled for quite a while, and now I think liquidity concerns are out the window.
Yeah, they've knocked it out the park, man.
Exactly. And I think you're going to see that with the tankers. I think you're going to see like even Nordic American tankers. I think they're starting to see a healthier balance sheet because they definitely needed it really bad. I think they were worse off than Scorpio in their liquidity issues, and it showed. And I think the tankers are moving in the right direction. And I think we should probably do another recap of this maybe at the end of the year to see where we are. But that's where I think we are. And I mean, if Calvin wants to do a quick sum up, he can go right ahead. Or
I'll
even
just do like a sliding scale of 5 companies. Okay. Just to kind of give you like, again, what kind of companies you're going to trade in shipping. Okay. On the far end of the spectrum of really good, you have your Frederickson stuff, your BW group stuff. Okay, these are, usually have, decent board ownership, insider ownership. Okay, these guys are invested. They're, BW Group is trying to make as much money as possible from their companies, right? You're investing alongside BW Group, right? They're a shipping and commodities company, and they are primarily getting money out of these stocks via dividends, right? That's how their corporate structure works. So you're very much in line in alignment with the primary shareholder. If your goal is dividends, maybe not huge capital gains, but sustainable capital gains. BW Group's kind of at the, I think that and Frederickson, the far end of the scale of the good scale. And then after that, you have, I'd put like really Scorpio and Ardmore and INSW and Teekay and I think all in the same tier. They kind of got their pluses and minuses. Like, I mean, Robert is, he's going to basically have the balls to do what needs to be done when the opportunity presents itself. Gurney is going to sit on his hands and, suck his thumb and, and just like, be terrified. International Seaways, who knows, what they're going to do, but they're not, it's probably not going to take action. At the same time, those guys aren't, like Scorpio might sell a bunch of stock at the top of the market, International Seaways, yep. Ardmore probably won't do that. Right. So I think, I put those in the same tier because like, it's probably better to own, like a Scorpio at the bottom. Right. Because, Bugby's way more invested in the company and its performance, and he's going to try to do, make the right decisions, but I don't think those guys are the same tier as BW and Fredrickson. Ardmore and International Seaways, they're kind of more, corporate focused. They're more, about their employees and their customers. Whereas, I think Scorpio is more about its insiders. But I think they are highly aligned with shareholders now. The BW groups, the Fredricksons, very, very aligned with shareholders. Go down below that and you have your, kind of not so great, not so terrible. I'd put like Star Bulk Carriers, for example. They pay a good dividend. They haven't been terrible on dilution, but then again, they've got like a meet from Douchebank out there putting out upgrades on the same day that the CFO is selling, 30,000 shares, which at $30, that's like $900,000, right? I mean, it's just kind of scammy, right? It's kind of fucking shady and scumbaggish to do that kind of thing. Okay. Now they're not going to totally rob you. Okay. So maybe that's okay. But you need to at least understand it. And then like below that, you have like your Sakos stuff, for example, right? You have your Nordic American. You can own these guys. All right. If you know what you own, they're going to dilute the shit out of you at times, especially if they're losing money. Right. I mean, they don't care if the common stock's going to go down. They're never going to sell their common stock. They're going to keep, if they dilute, they're just probably going to give themselves more shares via RSUs or whatever. So their dividend income stream, it's going to be constant. They don't care. Right. But at the same time, these guys will get really cheap and you can play them in a swing and, at least for a little while, they'll be aligned with you. And then at the very bottom tier, you have your, performance shipping group, your top shipping, your dry ships. And these guys, they are sociopaths. Okay. Like they see you as, like meat, like they're an animal in the forest hunting. Okay. And you are the prey. They are the predator. You are the prey. Okay. And, they have been doing this and they are for a lot longer than most of you. And they're a lot smarter than most of you. They've got degrees from Harvard and Yale and, London School of Economics or whatever in finance. And, they've been figuring out how to screw people for decades, right? They're very good at it. So you can play there. Okay. But you better be really, really, really good and on top of your shit to beat these guys. Right. So First tier, own it, hold it, forget about it, sell some covered calls. Everything's good. Tier 2, hold it, own it, but keep your finger on the trigger. Everything below that, man, you got to watch out. In that bottom tier, you better be a shark, man.
Yes, I agree with that.
So thanks for all your time. I mean, this is fun. We
yeah.
enjoy talking about this, obviously, right?
I love it. I enjoyed it too. It's really cool to hear your guys' thoughts. Maybe we can do it again sometime.
Yeah, I would like a panel maybe at the end of the year just to see how we did, see where we are. I mean, I know I talk to you, Mark, more often than I do on here, so I'll be glad to chat with you as well.
Yeah, cool.
And then maybe we can get you over to Marhelm. I mean, it's a good place. I recommend it to everybody.
All right.
I appreciate the recommendation.
All right.
Yeah.
Yeah. I'll put some links to you guys' stuff below.
Yeah,
Appreciate
thank you,
guys
Mark.
coming out.
Appreciate it.
It's fun chat. See you guys.
All right, thanks.
All right.
Yeah.
Later.
All right.
All right, bye.